A mortgage is a loan used to buy real property for which the property then serves as collateral. Borrowers have to go through a thorough approval process known as underwriting. This is to ensure the borrower presents a low amount of risk to the lender and has the ability to repay the loan. The applicant has to provide a large amount of documentation for underwriting. This includes tax returns, proof of income, credit scores, bank statements, and much more. The lender analyzes this information to determine if the borrower is financially able to purchase the property. Once a mortgage is granted, the property becomes collateral for the loan. In other words, the property itself represents the security for the loan. If the borrower defaults on their loan, the property can be seized by the lender and sold in a foreclosure sale in an attempt to recover the amount owed. For this reason, it's important the value of the property itself is at least equal to the amount of the loan. To accurately determine the value of a property, lenders usually require an appraisal. This provides the lender the current value of the property and determines whether the loan-to-value ratio supports the mortgage. If an appraisal shows a value less than the requested loan amount, the lender can require the borrower to pay a larger down payment or the loan can be denied. Consider a borrower who wishes to buy a property for $300,000. They apply for the loan, but the appraisal comes back with a valuation of $250,000. The borrower would have to come up with an additional $50,000. If they can't, the financing would probably be denied. In a mortgage, the borrower makes a defined amount of payments for the life of the loan. The two most common terms for mortgages are 15-year and 30-year loans, but there are terms for as few as 8 years. There are also a number of different ways for interest to be calculated and paid on mortgages. The two different types of loan interest are fixed and adjustable rates. In a fixed-rate loan, the interest stays the same for the life of the loan. In adjustable rate loans, the interest rate can fluctuate throughout the loan term depending on the current prevailing interest rates. Adjustable rate mortgages usually have caps that control how the rate can be adjusted. The interest rate offered to a borrower depends on a variety of factors, everything from loan-to-value ratio, credit score, and the size of the down payment. There are also what are known as discount points. These points lower your interest rate in exchange for paying a fee up front.